I will start off with this question here, Raphael. Does it feel to you like taking in all of the data that's out there, all of the economic data, that this is a turning point here in Fed policy?
Well, I do think that. I mean, I think it's safe to say that in the sense that for 2 years now, the inflation part of the mandate has really been the main focal point. And as inflation has come down, as the unemployment rate has come up, the risks to both sides of our mandate have really come much more into balance. And we're going to have to think hard about sort of what's happening in labor markets so that we can try to get to that elusive, calm, orderly return to normalization.
I was looking at the tail of the tape, and you've been at this inflation fight, if you count it from November 21, for 30 months. So I guess I'm looking for a more definitive answer here. Is that part over, and are we about to begin a process of normalizing rates from restrictive to less restrictive?
Well, I think we're close. Look, at the very beginning of this, I said we were going to have to raise rates, or we were going to have to stay at a high level for a long time.
Right.
We've been there for a long time, and now the numbers are starting to move in a direction which suggests that our policy has had its effect, and we can start the pathway to back to a normal policy posture. Look, we can't wait until inflation is at 2% itself to start moving. Inflation's come way down, so that tells me that we have to really think hard about that. And then on the other hand, we've had a lot of positive momentum in labor markets. That momentum seems to be easing up a bit, and that means that it is a sign that we're getting back to a much more normalized place.
I want to know how much currency you put into one of the arguments that kind of floats around in the hallways here, which is that right now, the Federal Reserve, on a real Federal Reserve funds rate, which is an inflation-adjusted funds rate, because the funds rate has not come down, inflation has come down. You know the argument. How much currency do you put in this idea that you're more restrictive now than you were when you raised to 538, and that no matter what's happened almost no matter what's happened in the economy, you need to be less restrictive?
I think there's a case to be made on that, and I've talked about passive tightening like more than a year ago. So I do believe that that's a thing. For me, I think the biggest issue and the focus that I've had is inflation sustainably moving back to its 2% target, and for the first part of this year, it was not clear that it was. Right. And so now for me, I've just really tried as much as possible to get that sense. And I'll say the numbers in the last couple of months have come in quite positive, have made me more confident about that. And I'm hopeful that the next 2 months worth of data points continue that pathway, because then it would say we're moving there. One last thing I would just point out, though, if you look at where inflation is, it is not particularly close to our targets. So we have an underlying inflation dashboard on our website.
Right.
It's all flashing red still. Now, it is not as red as it was. Like before, it was like bright red. But we still have a ways to go, and I don't think it's in our interest or in anyone's interest to just assume that we're done, and so we don't have to worry about it. So that's the other part that I think everyone needs to be mindful of.
I get that, which is why I sort of asked about this passive tightening thing, which is it's not really that you're at or near target yet. It's that you have scope to become less restrictive, but still putting downward pressure on both the economy and inflation, even if, for example, you get an upside surprise of 0.3 versus a 0.2 in the next one. It doesn't change the trajectory because you're on the way there and you already have quite a bit of restrictiveness in the funds rate right now.
Well, the argument makes total sense, and I totally agree with that. Here's what I would say. Inflation has come down faster than I expected, right? And for me, that says that it may be appropriate to pull forward our first rate move. I was in the fourth quarter. My outlook has been for the fourth quarter for quite some time.
And you only had one cut.
And I only had one cut, right? And so
is that changed now?
It is in play. And, we, in a couple of weeks, we'll have to do another SCP submission into the dot plot. And so as part of that, I will come to a more definitive view in that perspective, because I got to put a number in the table. But I will say.
Did you want to whisper the number to me now?
Not right now.
Okay, all right.
Maybe in a couple of weeks I'll call you. But look,
sure.
I think that you can't ignore the data. The data has come in a way which would suggest that it's going to be appropriate to be closer to moving than further. And for me, I just want to make sure that the next couple of data points are consistent with that,
right.
And then we'll see where we are.
Is the unemployment rate also higher than you had previously forecast?
It is.
Meaningfully so?
I wouldn't say meaningfully so, in the sense that the unemployment rate today is still, by historical standards, low. Right? We don't have a crisis in labor markets. And the way I describe them is they're weakening, but they're not weak. I want to try to remind people, right before the pandemic, we had one of the tightest labor markets that we've seen
before the pandemic.
Before the pandemic,
and then we lost 1 million people, and
then it became super acute.
Right.
And so the easing is coming off of that super acute environment. Sure. And so for me, I think the thing to be looking at right now is whether that weakening is accelerating in such a way that it starts moving closer to weakness. Now, that's not what we're seeing now. I talk to businesses all the time.
Right.
What they tell me is that while they're more lukewarm about hiring new workers, they don't have in their outlook laying people off as the modal thing. And
how did the 818,000 revision affect your view of the job market?
It didn't really change it that much. You know, our folks have told me that the world is changing in ways such that a lot of these data collection techniques,
we need to do better.
It's just hard.
Right.
And so they were telling me, there's going to be a revision. Whatever the number is, you should not assume that it's telling you a different story than what we're hearing from the hundreds of businesses and leaders across.
That's good advice for investors. Real quick, the market is priced for 4 rate cuts this year, or 100 basis points, 200 over time. I want to ask you what you think about how the market is priced, but I'm also interested in this idea. Where do you need to get to? Where should you be if you need to provide stimulus to the economy? In other words, how restrictive do you think you are?
So, look, I think we're restrictive. Earlier this week, I was with a bunch of folks who are in the housing industry.
Right.
And when you talk to them, they're like, it is very restrictive, and there's no question about it.
Help!
And there's not really a lot of ambiguity or debate on that point. So I do think that it's real. I do think the restrictiveness is real.
Right.
But there was a lot of momentum in the economy because of how we experienced the pandemic. And I think a lot of our restrictiveness has been trying to sap that up so that we're back to just a very more normal type of economic environment. So, look, I think that we're in a pretty good place right now. But I don't assume anything is going to stay that way. And
so is 100 crazy for this year? 200 crazy in a full year?
So, okay, let me say this. The markets have been eager to get us to be finished. And for me, I think we have to really remind ourselves that the U.S. economy doesn't move that quickly, and that patience is going to be warranted. And then the other part for me is we've seen through the last 2.5 years, the unexpected seems to routinely happen. And so I just have to keep my eyes open for that and not presuppose any pathway because that will send a signal that I think is not really going to be helpful.